Do you ever wonder why some traders are consistently profitable and others are not when trading market structure? Well, the difference between the two traders is how each one applies market structure. That's why in this market structure masterclass, I'm going to show you how to apply market structure the correct way so you can actually make consistent profits within the market. I'm going to show you the secret to selecting high probability market structures, and I'm going to reveal the number one reason why some market structures fail when you trade them, so you can avoid taking unnecessary losses and getting caught on the wrong side of the market. I'm also going to give you a complete market structure strategy that I personally use that has helped me generate over 6 figures in profit and payouts. So if that sounds good to you, be sure to stick around and watch this video all the way through to the end. Alright, so what is market structure? And I think it's very important that we start here because it's gonna make sense for the other things I'm going to be talking about further on in the video. So market structure is simply the structural formation of the market which helps us identify if the market is currently bullish or bearish in its simplest form. So in an uptrend, we all know that the uptrend consists of higher highs and higher lows, higher highs and higher lows, and continuously. That helps us identify that the market is in a bullish trend. And then in a downtrend, the market consists of lower highs and lower lows, lower highs and lower lows, and that helps us identify that the market is in a downtrend or bearish. Now, the problem with this is that it doesn't give us what we need as day traders, which is how do I actually act on this information? How do I actually go into the market and actually use this to make money? Because you might have experienced this, right? You might be able to go in the market and be like, oh yeah, okay, cool. I can see that price is in a bullish uptrend, right? And then you go in the market and then you get stopped out and you think, okay, but what happened? I saw price broke structure to the upside, made a high, then retraced, and then based on the basic fundamental ideas of market structure, I should have been able to catch a profitable trade. But then no, you get stopped out. And that's really frustrating, is that if we all know the basics of market structure, how come some people are able to make money with it and some people are not? And that is exactly what I want to tackle in this video. I want to show you how to actually use market structure in a way that actually allows you to catch profitable trades. All right, so how do we actually go into the market and select the right market structures? Like, what are the keys to understanding whether this is going to be a true break of structure or just a false liquidity sweep? Because I know many of you have experienced that, where you've gone in and you thought, okay, this is a break of structure, but then, okay, no, happens to be liquidity sweep and you immediately get stopped out. And the key to unlocking market structure is just understanding bias and the next likely draw for price, guys. This is what unlocks market structure. And the reason why I say this is because if we know what price is reaching for, we can anticipate price behavior to show its intention through market structure shifts in the intended direction at the right time of day. What do I mean by this, guys? So if we're bullish, guys, on the high time frame, right, and this I know is a terrible depiction of bullishness, right, but just think about it as a move down and up. If we're bullish on the high time frame, guys, right, you anticipate that if you're bullish, you want to see when price goes below old lows, you're going to anticipate that that's a false breakout because you know which side the market is actually delivering on. So then when you do see the bullish market structure shifts, you're going to know that that's actually confirming that price is actually now stepping into delivering on the buy side, because bullish market structure shifts are going to be holding, and the market structure shifts we're going to be looking for are the ones that happen after the manipulation happens at the right time of day. What do I mean by this? For example, if we're bullish, we're going to anticipate bullish market structure shifts that happen after manipulation at the right time of day to confirm that price is now in a buy program, and we're going to be anticipating bullish delivery after that market structure shift. And the reason why I say that after the manipulation happens, because the manipulation plays a key part to understanding how the delivery of price is going to happen. And by blending time of day, a time where we anticipate to see manipulation, we're actually able to get like an x-ray view of seeing price actually go from the manipulation phase to the distribution phase. And the market structure shift is what confirms that price is now ready to go in the distribution phase. And as you can see in our visual example here, we have our time of day here, right? That time of day can be London session, it could be New York session, it can be AM session, it can be PM session. We're just using that time of day because it's time before price. I know I've said this before and I'll continue to say it. Time before price. The times at which things happen is far more significant than price itself, because if price behaves in a certain way at the right time of day, that highlights intention. And obviously, if we're using the frameworks of accumulation, manipulation, distribution, we're actually able to see when price is manipulating and when price is stepping into that distribution phase, if we understand the bigger picture of where price is actually drawing to, where they might have an anticipation of bullishness in this example, right? So we saw price trade into a key level and then move away from it, breaking market structure. That's the confirmation that price is now stepping into its buy program and is now actually ready to start delivering on the buy side. And that's it. That's all we're doing, guys. We're literally just waiting for the right time of day, and we're waiting for price to go into a key level, and we're waiting to see a reaction away from that key level. And once we see that reaction from that key level, we're waiting to see price break structure in the true intended direction, because that's going to be confirming that price is stepping into that distribution phase. And that's it. That is it to trading market structure. You need to go on the hourly chart to see, okay, is price in the uptrend? Is price making high highs and high lows? Because that doesn't serve you. That doesn't give you a framework of understanding where you should be participating or looking for places you should be participating in price. Because in an uptrend, you're going to see price break structure low, but it's about knowing where and when you should be engaging in price. And by zeroing in the times and where we engage in price and waiting for certain things to happen, like price trading to a key reference point and moving away from it and showing market structure shift in the intended direction, you're building a framework and an understanding of which market structures you should be participating in. All right, so for the market structure strategy, this is what you need. You're going to need an understanding of knowing the next likely draw or the bias, right? Because that's going to be the building framework for us to be able to frame a narrative around, and for us to actually know which side of the market we should be working on and which side of the market we should be expecting market structures to hold. There is a way to do this without needing draw or bias, but I'm always going to push you guys to understand draw or bias, because it's just going to help you understand what you're doing that much more. Once we have the bias, we're going to need the time of day. The times of day that we're going to be using are going to be the London session, New York Hill Zone, and then we're going to be looking for in the AM session and then in the PM session. And the reason why we're using these times of days because this is where high probability price runs form. All right, we're going to be looking for that manipulation. So at that time of day, we're going to be looking for that opposing move that goes against the true intended direction of price. We literally want to see price go lower before it goes higher if we're anticipating bullish delivery. So that element of price going lower, that's going to be the manipulation, and we're going to be waiting to see that before we engage in price. Yes, there's going to be times where price immediately just goes without giving the manipulation leg. And what does that mean? That just means you don't have a trade. You're not looking for a trade. Sometimes you're not going to have trades, and that's okay. That's where you just have to learn to sit on your hands, because you want to be in high probability price runs, and high probability price runs that have that element of smart money signatures that are easiest to spot is where we can see that clear manipulation, because that gives us a clear visual of manipulation. And then from that manipulation, of course, we can then anticipate the next phase to be distribution. And then obviously we're waiting for that to happen. And then obviously we have our key reference points. Our key reference points are important because price likes to turn around at these levels. So if we see price meet these levels, right, and shows a willingness to move away from it, that's a confirmation that price is actually respecting this level and is actually going to be moving away from this level. And what's our key reference points, guys? Our key reference points are previous days lows, previous days highs, previous session lows, previous session highs, previous 3 days lows, previous 3 days highs, 4 hour order blocks, 4 hour fair value gaps, daily order blocks, daily fair value gaps. Those are our key reference points that we're looking for. The higher the time frame you go, the more stronger those levels are. And the stronger those levels are, the more they can produce a strong lower time frame reaction. That's why I said earlier, if you remember what I said, was that there is a way to trade this strategy without having bias or likely draw. Because if you think about it, right, let's say for example this level here was, let's say, a daily order block open, right? Let's say this level here was daily order block open. Let's say on the lower time frame, right, let's say on the 5-minute time frame, we saw price at the right time of day. Okay, this is very important. We saw price at the right time of day, right, trade into that daily bullish order block. And then from there, we saw that price moved higher, broke structure here. That break of structure is actually very significant because it shows that price has actually respected this daily bullish order block. So if we have a high time frame PD array, we can anticipate that there's going to be some sort of reaction on a lower time frame intraday that might produce a 30, 50, 60, 80 point move away from there. So when we see price actually break structure after trading into a high time frame PD array or high time frame level, we can actually use that as confirmation that price has actually respected this level and will either momentarily produce bullish price action, and we can just participate in taking that bounce. And you don't need to have a bias to understand that. But of course, you're gonna have to be cautious because price might trade into this daily bullish order block, right? Retrace and then continue, and then maybe it might trade into a, let's say, an hourly bearish order block, and let's say price is actually overall bearish, right? It might trade into that hourly bearish order block, and then we have to be nimble about this because we're not trading with a bias. If you're going to trade it without bias or draw, I say only stick to 4-hour order blocks, 4-hour fair value gaps, daily order blocks, daily fair value gaps, and you're going to be waiting for those to be traded to at the right time of day. And then you're going to go on a lower time frame. You're primarily hunting this up on the 5-minute time frame or the 15-minute time frame. You're going to wait for one of those time frames, whichever one shows you that bullish market structure shift first. For example, if it was bullish, right? Whichever one shows you that market structure, as price trades into one of those key levels I just outlined to you, you're just going to be waiting for that setup to form, and then you're going to be taking it as it forms. If you're on my free Telegram, you can attest to that. I'm not bullshitting when I say this is the backbone of my approach to actually executing on the lower time frame, because 99% of the free trades that I post in the free Telegram or the free breakdowns that I post, or just my trades in general, have an element of this. And I don't know why you're not in the free Telegram, links in the description below. This is the core essence of what I look for when I'm actually executing on setups, is this pattern here, because it just gives me that much more confident when it actually comes to executing price, because it's a confirmation element, because I don't need to catch the extreme low. Of course I can do it, and people on my Telegram again will test and tell you that I can, but I don't need that. I just need to wait for confirmation, and confirmation allows me to be able to respond better to price. And that's just the way I've learned, because I was always obsessed with turtle soups and, you know, wanting to know, how do I know when price is ready to turn around? And it was blending the things I've shared with you here right now: time of day, manipulation, understanding accumulation, manipulation, distribution, understanding key reference points, and understanding market structures that happen at the right time of day, with an overall arching understanding of where price is drawing to. It's that formula that helps put things together and just makes it easy to be able to execute on price with great deal of confidence. And that is what I do, guys. And yeah, so let's go into some real trade examples. And this first example is actually quite funny because this is one of the no bias examples. But as you can see, right, it was during the PM session, right? Price went and took out what was currently the low of the day. So there's going to be liquidity resting there. The more important thing was that it traded into a daily bullish order block open. And as you can see, price during the right time of day is trading into a higher time frame bullish order block. So we can anticipate that, okay, price might have a little bit of a bounce of or reaction from there, but we need to wait for confirmation that price has actually respected the order block. We don't just want to trade it as price trades into it, because what happens if price doesn't stop and just runs through it? We need to wait for confirmation that price has actually shown a willingness to respect that level and actually turns around. And what happens? Price obviously trades into that during the PM session, right? We have that bullish market structure shift happening after trading into a higher time frame bullish order block open. So that's a confirmation that, okay, we can anticipate that price, even though it might not be bullish for the whole day or for tomorrow, we can anticipate that right now currently price should deliver on the buy side because it's respected a high time frame PD array. For higher probability breakout structures, we want to see fair value gaps form within the leg that breaks the structure. That's what's called displacement, quote unquote. Displacement is just fair value gaps that are forming within the leg that actually breaks the structure, because that highlights intent, especially when we're trading the no bias approach. Seeing fair value gaps forming the leg that breaks the structure is very key in just framing high probability market structures anyways. So as you can see, we do see that breaking structure and price retrades, of course, below 50% of the range that it took to break that structure, right? Below 50%, and then would have been able to take our setup. Our stop loss would have been at the low that formed prior to the break off the high. That's where we want to have our stop loss at, because that's going to be our protective stop loss, because we're going to be anticipating price to hold that structure if it's actually going to be delivering on the buy side. And obviously, an additional to add this and sweeten the deal was that as price was actually taking out this current day low, right? If you go and cross-reference ES, right, you're actually going to see that ES was actually failing to take this low out. So we had actually had an SMT. So NQ was making lower lows, but ES was actually failing to make low lows. ES actually made high lows. So that's actually a further confirmation, especially when we're trading with our bias. And obviously there's other things that you can add to it to further enhance the logic. I actually did take this setup in my Telegram. I posted it. It was just a little paper idea. I did take it, outlined as well. So I did go into a lot more detail what else you could have added in to make this setup make sense without needing a buy. So go check that out. All right, in this example, this is a gold example. By the way, guys, this just doesn't work in NQ, ES, and Dow. It works in gold, it works in Forex. And this up, as we can see, right, during the New York session, we're seeing that clear manipulation. Price is trading within a high time frame level, which is that daily fair value gap, right? And as you can see, during the New York session, a time of day where we anticipate to see manipulation, we anticipate to see these market structures form. We see, what do we see? We see price starts turning around during the New York session, right? Breaks structure whilst within a higher time frame PDR, which is that daily bullish fair value gap. Obviously, we're going to assume we're bullish for the day, right? We're not just going to be trying to use a no bias approach. No, we're going to assume we're bullish for the day. Obviously, the no bias approach would have worked in here as well because we're utilizing a high time frame level. But assuming that we're bullish, right, you're going to be able to see that these moves actually are much more powerful when you have a buy. So we get that breaker structure here within a high time frame fair value gap. We have displacement because our fair value gaps within the leg that breaks the structure. This is a high probability confirmation that price has respected the fair value gap, and price is actually now ready to start turning around, and price is actually now in a buy program. So we have that clear manipulation ahead and going into that New York time. People are thinking sell, 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 sell. We have a bullish understanding that price wants to deliver high. So we're seeing this and thinking, okay, price is within a high time frame fair value gap. All we need to do is just wait to see the confirmation that, okay, price is now ready to turn, and then we do get that breaker structure. Price retraces below 50% into a fair value gap, and then as you can see, after the market structure happens within a key reference points within a higher time frame PDRA, price then now starts to deliver on the buy side. And then you see price breaks structure again here, and then respects this range, continues. Now your order blocks start to work. Now your fair value gaps are working because price is now in a buy program. So now there's bullish order flow, so now price should respect bullish arrays. All right, in this example, guys, this is another gold example. We're going to assume that we had a bearish bias. So as you can see, the setup formed within the AM session. At that 9:30 mark, we see price runs up into what? A key reference point, previous day's high. So as you can see, price at 9:30 manipulates into that previous day's high. We already have an anticipation that we're bearish, so what we're going to do is just wait for that market structure break to the downside, and then we're going to be participating on the sell side of the market. So what happens? Price runs into that previous day's high at the right time of day, and then breaks structure lower here. Right, we have that breaking structure here. We have that nice clean displacement because obviously this was the most recent high before the break lower, right? We have that nice clean displacement, nice fair value gap slicing through that lower, right? That's a nice clean break of structure. That's an intention. We think about the logic and the narrative behind it. We've ran previous day's high. We're already anticipating that price is going to be bearish, right? We see displacement towards the intended direction at the right time of day. So that's just a banging deal. We take our short set up above 50%. Obviously stop loss at the high that broke the low, right? So our stop loss have been here. So as you can see, price never traded into our stop loss. And then what would our be targets? If we have an overall bearish bias, right? What we're targeting, we're going to be targeting key liquidity. So key sell side liquidity is previous session lows, previous days lows, obviously previous 3 days lows. Those are the key liquidity points we're going to be targeting if we have a bearish bias or have a bearish drawn price. I always advocate for taking a 2-to-1 or, you know, trading your stop as price progressively goes in your favor. But anyways, that's beyond the scope of this video. So yeah, would have gotten here, and then obviously we have our New York session low here, and then as you can see, price ultimately draws into that. That would have been a nice setup. All right, let's go into another example. All right, guys, in this example, we have NQ. We're going to assume we're bullish for the day. As you can see, during the New York session, we see that clear manipulation happen going into previous day's low. And actually was another additional bonus. Actually went into that old new week opening gap. But so that was a further point of support, right? But anyways, we have that our key reference point, which is our previous day's low. Price trades into it right during the key time of day. Obviously this was a news release, right? Slams into a previous day's low. We understand that we're bullish and we have a bullish draw on price, so we're going to anticipate that this is not going to be no break of structure lower. We know that this is probably a false breakout for price to actually just sweep liquidity and then trade in the intent direction. And what we're doing is just waiting. So then what happens? We wait, and then once price takes that previous day's low, price begins to turn around, shows displacement, breaking this market structure shift here. That's confirmation that now price is ready to start delivering on the buy side, right? And that's what exactly we're waiting for. Price retrades obviously 50% off that range, did way below 50%, right? But let's just do 50%, right? High to the low that broke the high. And obviously we trade that 50% there, way below 50%. We take that 50% setup. Our stop loss would be at the low there, and then we see price proceeds to trade higher. But as you can see, once the market structure shift happened, guys, once price is confirmed that it's ready to actually start delivering on the buy side, we can see that okay, we have this order block here. Price retrades, it's find support there. We have this fair value gap here. Price tags into a little bit, runs. So you see how price is now in bullish order flow after the confirmation using the market structure that price is now actually ready to start delivering the buy side, guys. And then we just take different setups, and we can take continuation setups and things like that. If you guys do struggle with bias, I'm going to link a video to understanding bias that's going to improve your understanding bias, because you probably already know bias, you just don't know you know that. So I'm going to link this video right here, and I hope you guys found value in this video. If you did, let me know in the comments below what you found valuable. I really hope this opened some eyes for you guys, and you guys actually see market structure in a different light, and you actually see market structure in a way that you can actually consistently apply it, because that's the aim of these videos. I want to make these things as clear for you as possible, so you know actually what you're doing within the markets. I just don't want you to just give your strategy and then you guys just don't know what you're doing with it. I want you to know the understanding behind why it works, and that's why I give you these frameworks of then going into the market. So if you do find that valuable, please leave a like. Let me know in the comments below as well what sort of videos I should make going forward. I do post videos every week around IC concepts and prop funds and things like that. So yeah, like, comment, subscribe, and I'll see you guys in the next video.